What's up, y'all? Welcome back to the Mining Pod. For today's show, we have Reggie Smith, an executive director of equity research at JPMorgan who covers Bitcoin mining stocks. He is a wealth of knowledge and comes packed with information on all of the leading Bitcoin mining stocks. And over the show, we talk about some of his strategies for how he analyzes these stocks, the things that he looks for winners and losers. And of course, we touch on the AI question and ask him which strategies he thinks will win out in the long run and which stocks he thinks are well positioned for the coming AI boom. So without further ado, let's hop into it with Reggie. But first, a quick word from our sponsors.
Are you a retail or institutional investor interested in Bitcoin mining companies? The Miner Mag brings you free data and analysis from all major NASDAQ-listed Bitcoin mining operations to know who stands out. Check out visualized metrics and data-dependent stories at theminermag.com. Thanks for listening to The Mining Pod. Want more? Subscribe to our main feed on Apple, Spotify, YouTube, or wherever else you get your podcasts for another weekly show on Bitcoin stocks. And check out our newsletter at miningpod.blockspace.media today. Hey, welcome back to the Mining Pod. On today's show, we're rejoined by Reggie Smith of JPMorgan. Colin, you're also here with me. How you doing this morning, guys?
Good, man. How are you? Good to see you.
Good to see you as well. Bitcoin is pumping yesterday. We almost had a 10K day, which we won't dig into too much on the show because
pumping, it's ripping, bro.
It's ripping. It's ripping. But you know, here on the Mining Pod, we are all about the facts and the figures. We're getting into the analytics. We're not too much price pumpers here, though. I think all of us are pretty long Bitcoin, or at least Colin and I are. Reggie, we got so much to talk about with mining. You've been putting out a lot of reports. I actually am just kind of curious. You're on like the Fintech team at JPMorgan. So like, is all your time now focused on mining? Like, do you have time for anything else?
You know, it's funny. Yes, we do spend a lot of time on the miners. The beauty of the industry and what I love about it is that they give you so many metrics. There's so many numbers that you can analyze. And it's one of, I've covered stocks for almost 20 years now. And no other industry that I've ever looked at has the just volume of data and metrics that you can dig into. Companies give you monthly updates on how many coins they mined. And like, there's just so much work you can do. And so it keeps us busy. And I love it. So yeah, we do. I probably publish more on Bitcoin mining than any other company that I cover. But it's great.
Is that almost is that blessing also somewhat of a curse? Because I've found this whenever I've been crunching numbers on Bitcoin mining stocks. It's like there are so many metrics and, a company might have a really good EV revenue ratio, but they might have a terrible, price to book or vice versa. I mean, there's almost... Even to this day, there still seems to be almost no standardization for valuing some of these companies based on these metrics, right?
No, you're right. You're right. And so it could be a curse to some, but like I love doing the work and figuring out new ways of thinking about things. For my role and my job, your dream is to have a sector or some type of drama or confusion in the market where you can lend value. And so it's, I wouldn't even call it a curse. It's just a gift to be able to analyze a sector that's so vibrant and so volatile.
Can you tell us about your mandate before we get into it? Like, what is the mandate of your position as an analyst at JPMorgan? What's the end goal that you guys are striving for with this position?
Sure. Yeah. So I'm part of our equity research. And like you said, Will, I cover Fintech, but also Bitcoin mining. And so my job or my role is we publish independent research and give our views on companies' valuation, which stocks we like, which stocks we don't like. Our client base are institutions. And so I don't usually talk to individual investors. My clients are hedge fund managers, mutual fund managers, portfolio managers, folks at that level that are running millions and millions of dollars worth of stocks and positions. And we put out research when news hits or when we're working on a project or if we have some new finding or insight. My day is oftentimes filled up with like calls with clients. And like I said, I cover Bitcoin miners, but I also cover Fintech stocks and lenders. And so every day is different. And as news hits, we're reacting to news and giving investors and clients insights on how to think about stocks. Colin, you mentioned a very interesting, I guess, little feature of the Bitcoin mining space. and it's worth kind of pointing out. So for most established sectors, so old economy companies, there's an established framework for valuing companies. And what I really like about the Bitcoin mining space is that we're literally writing the book on how to think about these names. And so, I cover payment processing companies, and there's a very structured framework that everybody accepts on how to think about and value these companies. With Bitcoin miners, like we've evolved our thinking on how to evaluate the companies, and so it's beautiful to be able to literally write the book on these stocks. And so that's one of the aspects that I really enjoy about the role and specifically this sector.
Do you think that's specifically just because it is still so young and there are so many information asymmetries?
100%. Yeah. It's so young. That's exactly what it is. It's not a widget type business. Like it's a very unique business model in industry. And so like all of that kind of contributes to that issue.
Well, you just put out an October report covering 14 miners. So that's actually where I want to go to my next question, just so the audience can understand the mandate JPMorgan and like banking analysts have in general. Why do you guys only cover 14? What are the things you're typically looking at? For those who aren't paying attention, maybe you can kind of describe how these reports look like. And then we're going to get into like the nuts and bolts of the conversation after that.
Yeah. So to be clear, I only cover 5. But since we do work on those 5, we also look at the rest of the industry. And so anybody that looks at the Bitcoin mining space understands that like once you've covered one or you cover the industry, like so much of what one company does or what one company is experiencing is relatable to other companies. And so in our monthly piece that we put out every month, we look at the performance of all of the Bitcoin miners. We look at network hash rate, difficulty, Bitcoin prices, hash price. And what I'm trying to do for investors is give them a sense of, where are profitability trends for the sector and how are the stocks being valued, and is it a good time to buy? Is it a bad time to buy in relation to those types of metrics?
Awesome. Okay. So I want to go through more or less like the thing Bitcoin miners are chasing in the eyes of JPMorgan or the eyes of an analyst, and how you guys quantify that. And then I want to talk about the cost side of things. I feel like the thing that Bitcoin miners are chasing is pretty obvious, but how you guys quantify it is interesting. Typically in these reports, you guys take the amount of Bitcoin still have to be mined, and then you guys multiply it by the price of Bitcoin. And then there's some sort of consideration for things like transaction fees. But tell me about how you guys quantify that side of things that Bitcoin miners are chasing, like the market for Bitcoin mining.
Essentially, I guess by way of background, I started my career in energy trading. I used to work for a company called Enron back in the early 2000s. And so I had a background initially in kind of energy. And one of the concepts that is popular in the energy and oil exploration industries is this idea of kind of proved reserves, where you have a sense of how much oil is in the ground that you can extract. And so we took that concept and applied it to Bitcoin mining. And so we all know that there's a schedule for like when coins are mined or released, and you can estimate like with fairly certainty the number of coins that are left to be mined between now and the end of time. And so right now, there are about 1.2 million coins left to be mined. And so we took that concept and said, all right, if right now these companies are primarily trying to, or in the business of mining these coins, this represents, kind of the revenue opportunity. And so one of the things we look at is we'll take that 1.2 million and we'll multiply it by the price of Bitcoin today. And you get a number with that. And at the end of October, that number was 87 billion. And so if you're thinking about it in terms of like, what you're playing for at current market price, you're playing for about $87 billion over the course of, the mining schedule, right? The Bitcoin mining schedule. Now, so we take that number and then we look at, all right, now what are these stocks trading at? And so we'll look at the market cap of the different companies to say, like, what are they trading at in relation to that number? right? And I don't know what the right multiple is, but what you're able to do is look back over time to see, all right, historically they've traded, let me pull up my numbers here for you guys. On average, since the beginning of January 22, the Bitcoin miners, 14 US listed miners, have traded on average at an aggregate market cap that is 18% of the nominal value of the Bitcoin remaining to be mined, right? And so with that information, you can just do a spot check. And like every month, you can look and say, all right, the average is 18. Today it's 15. That's probably a good time to kind of buy Bitcoin miners. Or contrarily, you can look at it and say, hey, the average is 18. Today it's 30. The stocks appear to be trading rich relative to historic, context. And so I don't know what the right number is necessarily, but you can kind of use that as a framework. Now, what's interesting, and we published this number, there seems to be a band where the stocks, will go this high and then they start to sell off, or this low and kind of come back up. And so, looking at that framework, you can use that kind of to say, hey, we think the stocks are a little hot right now, a little cool right now. It's probably better to buy, probably better to sell. And like I said, that number is always changing because the market caps of the companies are always changing, and the price of Bitcoin is always changing, and the number of coins remaining is always declining. And so that's kind of our framework for looking at these things. And for what it's worth, as of the end of October, the miners in aggregate, the 14 that we track, were trading at roughly 29% of the proved reserve, which is that number that I talk about, the 1.2 million coins times the price of Bitcoin, which again is kind of rich relative to an 18% average over the last 2.5 years. And so we're unique in that regard. I also have another metric where I drill down even further and look at the amount of coins that will be mined in the next 4 years. And we use 4 years because that's typically the life cycle of a machine. And so you tend to get similar conclusions, just a different scaling. But like I said, you tend to arrive at the same conclusion. You can use that again to figure out whether stock looks cheap or rich.
Gotcha. Okay. So that's the side that miners are chasing. Now let's go to the cost side. Walk me through like the cost structures that you sort of think about when you think of Bitcoin mining. And of course, for like listeners, this is like ASICs, infrastructure, staff, SG&A, all those sort of things. So how do you kind of parse out that side of Bitcoin mining?
Yeah. So that's a very good question. We can go a lot of different ways.
Yeah, we can spend some time on it for sure.
We can. So let's start with kind of the machine cost and like building out a facility. And so the amongst the miners that I cover, the 5 that I cover, and most of the other larger cap Bitcoin miners, they typically spend anywhere from $400,000 to maybe even $1 million per megawatt to build out their facility. So that's kind of the run rate or the range of input costs. So if I'm building out a 100 megawatt facility, Bitcoin mining facility, I could spend anywhere from $40 million for the infrastructure up to like $100 million. And the cost differential is usually driven by how elaborate is the cooling? Are you doing liquid cooling, immersion cooling? Is air cooled? Location, things like that, right? So that's kind of your first kind of key input. And so you've got some decisions to make as far as how much you want to spend on your facility. Once you got your facility up, the next key input would be the cost of the ASIC. And so what we've seen over the last, I'd say probably year and a half, is that the price of an ASIC miner per unit of compute has collapsed. And so to give you some perspective, when I first started covering the space in late 21, it would cost you about $30 per unit of compute to buy an ASIC miner, right? When Bitcoin rallied in 22, we saw that price go up to 80. And then Bitcoin crashed in 22, 23. and we saw it go back down to like 20. Today, new ASIC miners are being priced $15 to $20 per unit of compute, and so it's fairly cheap and attractive. The other thing with the newer machines is you're thinking about, or key consideration is how efficient are those machines and how much power does a machine use? And so you've seen the power efficiency on machines improve dramatically over the last year. And so right now, you can get a top of the line machine that is probably twice as power efficient as stuff that was built 2-3 years ago at a fraction of the cost of what you would have paid a few years ago. And so that's kind of your base kind of cost estimate. From there, operationally, you want to think about your power costs. And so your biggest variable cost would be, what are you paying for power? And for big Bitcoin miners, large scale and industrial grade miners, they're paying anywhere from high 2 cents to probably 5 or 6 cents per kilowatt hour. And so that's kind of your in if we were using your car as an analogy, that would be what you're paying for gas. The second thing, or the next thing you want to think about, is how efficient are your machines. And so that would be, in the car analogy, how many miles per gallon do you get? And there's a lot of variance there. So if you got newer machines, you're going to use less power per unit of compute. And so you've seen the bigger miners over the last year or so really grow their fleets. And so when you look at those guys, their efficiency or their machines or their fleet has gotten, dramatically better. And so those are, at a high level, how we think about, kind of core operations. So, how much did you spend to build your facility? How much did you spend on your machines? And then how efficient are those machines, and how attractive is your power pricing? Beyond that, so that kind of the top of the income statement.
Yeah.
As you move down the income statement, the other thing that is getting a lot of attention with investors and clients that I talk to is operating expenses, and so overhead. And so, how much are the executives being paid? Like, how robust or how lean are their corporate functions? And so you've seen, companies be penalized for, spending a lot on overhead and stock compensation and things like that. And so that would be another element of kind of cost.
Today's show is brought to you by Digital Shovel. Digital Shovel is a leading manufacturer of modular mining pods as well as PDUs and switchgears. Unlike many other competitors, their product is designed and manufactured in North America with a complete UL inspection on the entire unit, not just individual components. Additionally, Digital Shovel is one of the most vertically integrated manufacturers of over 75,000 square feet of sheet metal shop, SMT and wave solder PCB assembly, as well as final assembly all under one roof in Toronto, Canada. Their price point leads the industry when compared to products with rates as low as $69,000 per megawatt for a complete data center with smart PDUs and switchgears. To learn more, visit digitalshovel.com. How do you see those costs changing as these miners start delving into AI and HPC? Everything from CapEx to OpEx. I mean, you had a great report out, I think, last month that looked at the estimated cost for CapEx for an AI and HPC fleet, which was like $30 million per megawatt for just the machines. Yeah. And then if we're talking about greenfielding, I think the estimate was like 10 to 20 million per megawatt. And then if you're retrofitting like Corsair, it was like 5 to 7 million.
Yeah. Yeah.
So how do y'all think about kind of shifting your analysis considering those cost factors?
For sure. Yeah. So there's a lot to kind of unpack there. And I'll just summarize the numbers you kind of threw out there quickly. So what we found is that, for a Bitcoin miner today, if they're building capacity from scratch, so that's going to be infrastructure, so the building, cooling, et cetera, buying machines, they are spending anywhere between $1.5 million to $2 million per megawatt. In comparison, or in contrast, if you're building an AI data center, like you said, you may spend $30 million per megawatt on just the GPUs alone. And then the infrastructure could cost another 10 to 20 million. So that's if you're doing a tier 3, top of the line, kind of data center. And so just, for comparison purposes, you got 2 million on one hand in CapEx versus anywhere from 40 to 50 million per megawatt for AI. And so that's a big number to be able to do that. To your point, Core Scientific announced a deal with CoreWeave about 4 months ago. And their CoreWeave is essentially going to pay to upgrade Core Scientific's facilities to make them AI grade, HPC grade. And they're going to spend anywhere between 5 and 7 million per megawatt, which is a lot lower than the 10 to 20 million per megawatt infrastructure costs I mentioned earlier. And so what we've kind of concluded in talking to different operators is that, tier 3 data centers and tier 4 data centers are, top of the line. They have very high uptimes, power redundancy, et cetera, et cetera. Very expensive to build because power redundancy costs a lot of money. If you're comfortable with, a slightly lower uptime ratio, you can build a site significantly cheaper. And so we kind of call them tier 2.5 data centers. And our math in context suggests that those can be built for anywhere between 2 million to 12 million per megawatt. And most of the miners that we've talked to that are doing HPC build-outs are thinking about, offering, or developing kind of tier 2.5 or slightly below top of the line data centers. So we can get into the implications that has on the kind of AI work that can be done there if you'd like.
Yeah, can we actually? Because I think that's the most interesting question. Mining Pod listeners will have heard this before, but I keep coming back to how liquid is this compute, right? Because when you look at Bitcoin mining hash rate, you're selling it to the network directly or you're selling it to a pool. Right. That price more or less converges on hash price. And there's not very much deviation between what one miner is going to get for their hash rate and versus another one. But that is not the case for this compute that they're trying to produce for HPC and AI.
For sure.
So what kind of clients would like a tier 2.5 data center have?
Okay, so let's talk about like a tier 4, tier 3, right? So just to kind of level set, those are going to be data centers that are more than likely in close proximity to a major metropolitan city, right? So very, very close. So, the way we think about it is if there's an NFL team in that city, like you're going to probably be within 40 or 50 miles of a city that has an NFL team. And you want that because you want very low latency. And so you want the information to travel to the data center and then back to whoever's using it as quickly as possible. They're also going to have, much higher uptimes. And so, if power goes out, like these things have to be constantly running. And so the types of workloads that would use that could be like autonomous driving. Like you can't afford, if you got autonomous driving, you can't afford the system to be down or there'll be a delay because, oh my God, you crash, right? Things like that. Also some like, market and trading type operations where latency and you can't afford to miss even a second, so like those are going to be the types of workloads. So conceptually, stuff that's very time sensitive and needs to be on all the time would be the ones using the tier 4 stuff. And with that, you would expect that user of that compute to be willing to pay a lot more for that certainty of knowing that it's always there. As you think about, as you move down and you're comfortable with a little more latency, you're not as concerned about getting the data back to you as quickly, or if there's a blackout shortly and you have to go down for half an hour, it's not the end of the world. So if you're doing like AI training, things like that, where it's not as time sensitive, you could probably use a data center that's a little farther from a major city, longer latency. Maybe it's in Texas. Maybe they have to shut down when power prices spike or power's in short supply. It doesn't ruin your business. You can pick back up with your whatever it is you were doing. And so for that, it doesn't cost the data center provider as much to build that facility. And so they don't have to charge as much for the compute. And so it really boils down to like latency, reliability and things like that. If you're comfortable like sacrificing that, you can get, a facility built a lot cheaper and you could pay a lot less for that compute. To give you some perspective on what we're hearing, for the pricing for like compute, it's typically quoted in like dollars per GPU hour. And so the range that we're hearing is anywhere from $2 to $5 per GPU hour. $5 would be the more, time sensitive, always on stuff. If you're a little more comfortable with a little bit of latency or downtime, you could pay $2 per GPU per hour.
Let's go to some metrics really quickly before we dive more into the AI stuff. And I want to get your thoughts on some of the metrics that we see reported month over month. What do you care about as a bank analyst, and what do other bank analysts care about? Every single miner loves to put out different metrics month over month. And, we know the ones that the SEC requires for quarterlies, and we know that we are required, or miners are required to put out quarterlies, but the month over month stuff is interesting for retail, especially. We even do live streams around it for the mining pod because we get so many retail participants who are interested in it. What is a noisy metric, and what's a metric with good signal in your opinion, or maybe a few of them?
Thinking about noisy, I'm gonna come back to that. I think
Colin might have some thoughts too. So
the things that we look at, obviously we want to see, and all of the companies don't provide this metric, but an average operational hash rate is a good number to have. Most companies will report ending hash rate, and it may not even be fully operational, right? And so like having a sense of like, what was the hash rate that was actually on throughout the month is very important. Then from that, you can start looking at, all right, how many coins are they mining per unit of operational hash rate? And what you'll find is that there's pretty wide variance across the space, where some companies or operators are much better at keeping their machines up and running. Others, for whatever reason, have to take the machines offline. And so you'll see a pretty wide variance in terms of how many coins are mined per unit of hash rate. Obviously, the more, the better. And so that's something that we track over time. And you don't see the rankings don't really move around a whole lot, but there is, like I said, a pretty meaningful variance amongst the companies in the space. And so again, you want good hash rate growth, and you want good efficiency there. We don't typically get power costs for companies, but in the monthly releases, but that's also a very key input, particularly as you get to like earnings and things like that. And so those are kind of the hot things that we kind of look for. And then what we had, for like the last year or so is that companies were on the hunt for new power supply and new hash rate. And so, a lot of times a company would say, hey, we've expect to hit this hash rate by year end. We just signed a deal for more machines, and we're going to pull that forward. And so we think we have a higher target at year end. And so basically the change in how companies are thinking about their hash rate growth kind of going forward.
Colin, feel free to jump in there. One thing I do want to ask about those, how do you guys think about SG&A? And how do you guys think about some of the marketing dollars that are spent out there? Maybe you guys don't care too much, as long as it just like kind of fits the profile of a normal budget for a Bitcoin miner. But that's a topic on Twitter day in and day out, is SG&A costs.
It is. No, it's very important. I'd say in the last probably 3 or 4 quarters, it's gotten increasingly important, where, management teams are being, kind of held accountable for, what's going on with their SG&A growth. So we definitely look at it. We typically only get that when a company reports results. And what we've done in the past is, we would kind of read through stock compensation, because that's not a cash expense. But we've seen some companies, their stock compensation has spiked in recent quarters. And so now we're starting to look at that as well. Are they issuing a lot of options and stock to executives? So that has become a very hot button. Another thing, it's not an explicit cost, but the 5 companies that I cover, for the most part, have been pretty active on their ATMs. And so what that is going out and issuing stock that they then use to, build sites, buy machines, et cetera. But it dilutes the existing holders. And so it's a metric. We put out a quarterly piece every quarter where we look at, how much stock did these companies issue during the quarter. And it's kind of it's almost a necessary evil in some cases because everyone's so focused and starved for hash rate growth that having an ATM authorization is a competitive advantage on one hand, but like I said, it dilutes shareholders.
Right. And like you said, sorry, go ahead. Finish
and what I was going to say is you have to be of a certain scale to have an ATM open, kind of shelf registration. And so what has happened is that the larger miners have gotten larger and they've kind of left the smaller operators behind. And so it's kind of a minimum effective dose that you need to have to play that game. And so you're starting to see haves and have-nots develop where the bigger miners have gotten bigger and the smaller miners have kind of stayed where they are.
That's they
don't have the capital.
That's a really salient point because the ones I can think of off the top of my head are like Marathon, CleanSpark, Riot. Riot had a $750 million ATM open. I think they rolled it over. So now they have a in-kind ATM now after that one was closed last quarter. Marathon obviously is like the king of dilution. Marathon investors are constantly pissed off at the fact that they keep issuing stock. But you said that it's a necessary evil, and it really is because outside of that, there are really only 2 other avenues that we've seen most commonly, which was ASIC-backed loans, which failed spectacularly in the last bull run and ensuing bear market, and Bitcoin-backed loans, which a little bit better. And honestly, like if I were an investor, I would rather them go that route potentially because if you're Marathon, you got 27,000 Bitcoin. Why aren't you leveraging some of that? Even if you have to over collateralize it, you have a huge trove that you can then draw on. But
the risk there though is again, like you said, like if things go the other direction,
But so we've seen Marathon and a few other miners get access to what I would call more traditional lines of revolving credit that do not require, a Bitcoin-backed loan or something like that. Going back to the necessarily evil comment, dilution has been really the only way for them to supercharge their financing. Do you see this changing over the next 2, 3, 4, 5 years? Will miners finally have access to capital markets in a way that is, I don't want to say fairer, but they might have access to debt in ways that we would expect from other more traditional companies? Or do you think that Wall Street's still going to be like not for me, these highly volatile, high growth stocks. We don't want to touch those. They rip on the way up, but they tank on the way down. We don't know if the credit risk is worth it.
Right. It's a great question. I think some things would need to change in the industry for that to happen. Right. So one of the things, and we haven't talked about it today, but a theme that I tell investors consistently is that I think the space is overinvested from a CapEx perspective. And so by that, I mean, if you look at the profitability of the industry in total, and compare that to what's being spent in CapEx. And, we talked about, hash price and how it's come down. It keeps kind of trending down. That's a function of there being a lot of competition, a lot of hash rate growth. And what I've said, I don't know when it happens or what the exact ratio is, but ultimately I think CapEx for the industry should be some percentage of gross profits. Right. And it shouldn't be all of it. And it should be more than it. Right. So there needs to be some rationalization in the market so that you can ensure, a nice solid capital return for these miners that would then allow lenders to get, more comfortable.
Right. Because a lender might look at Marathon as like you're never selling what you're producing, so you're not totally sure whether or not you're going to be able to see cash flows from these operations. At least traditionally you haven't. Marathon has survived on dilution and I'd even add to that,
conceptually, difficulty, the network hash rate should track the price of Bitcoin, right? So in a rising market, you'd expect more people to bring on hash rate. In a falling market, you would expect hash rate to kind of leave the network, which would kind of stabilize profitability. Over the last couple of years, we've definitely seen the correlation on the way up, but you've seen hash rate stay solid and even increase in the face of falling Bitcoin prices, which is not, what you'd want. Like, if you're going to issue debt, if you're going to loan somebody, money, you'd like to see some type of governors to protect you, on the downside.
Yeah, now, you would expect to see what we see in the oil markets maybe a little bit more, where it's like supply goes up, price goes down, demand goes up, supply increases. But like you said, with hash rate, theoretically it should do that, but on the way down, we don't see that at all.
We certainly haven't seen it, historically, at least not in the last down cycle. But there's so many nuances there, and you've got some operators that are acting irrationally, I think, in some regions. So it may be sovereign funds that are just continuing to mine regardless of price, or someone that maybe has a power cost advantage or subsidy where they can mine even when prices are lower. So there are a lot of things that kind of make the market kind of complicated in that regard. Something we do that we look at. So at the end of each quarter, after my companies have reported results, we tend to go back and we'll do like a deep dive and a comparison of all of the companies, and we'll look at profitability metrics per company and growth and things like that. But we introduced this metric that tries to estimate industry-wide gross profits, and we use some of the network efficiency metrics from Cambridge University Bitcoin school, and we're able to track like the profitability of the industry. And what's interesting, so we look at kind of gross profits, and so like we look back and we take basically the number of coins that are mined in a particular quarter, average price of Bitcoin, and then we estimate the power draw based on the network hash rate and efficiency and some power costs. And what we found was that, in the last 3 years, gross profits for the industry peaked in 4Q21 at about $3.7 billion. So that's Bitcoin mined minus power costs for the entire industry. We had it spike to 2.7 billion in 1Q24 before the halving. But last quarter, we had it only at just about $1 billion. So that number should kind of inform CapEx for the industry. Like, you can't continue to add hash rate and spend money if the profit pool is shrinking. So it's something we love to see, some more rational behavior in the market in general.
In the competitive world of Bitcoin mining, one name stands out: CleanSpark, America's Bitcoin miner. At CleanSpark, efficiency isn't just a goal, it's our standard. Our sophisticated facilities are built and led by expert teams who care about Bitcoin and the communities we work in. Scale, we've mastered it. Our large-scale operations have set us apart in the industry as examples of community-oriented building. Our track record speaks for itself. We navigate the complexities of the new economy with precision and with skill, continuously achieving operational milestones. Curious about how we do it? We invite you to discover the story behind CleanSpark's success at cleanspark.com.
Let's move over to AI. I'm going to steal one of Colin's questions that he got down for us. Which AI strategy, retrofit, acquisition, leasing, is more likely to win out in the long term? This is an interesting one because we have seen so many different strategies, including some strategies that you didn't list there, which is just issue press releases around AI and actually don't do anything with it. So
that's the default strategy. Everybody does that,
right? That's assumed,
Yeah.
But in all seriousness, when you're looking at these different classifications of miners. And we talked about this before, Reggie, is like you have the pure play miners like CleanSpark. Their intention is just to mine Bitcoin and be very good at it. You have like the mushy middle, which is like some press release game, but some also build HPC data centers or purchase retrofit. And then you have like the cores of the world, which they're still mining a ton of Bitcoin, but they have this CoreWeave deal. They're focusing on that more and more. So when we're looking at those three buckets and we're looking at the different ways of going to AI HPC, what do you think is most profitable at it or best way to approach a strategy?
So it really depends on the company. And so I'm going to give you a couple of different variables that will kind of help you decide, what's best for you. So number one, I think, understanding the management team and whether they are, Bitcoin maximalists and are super bulled up on Bitcoin. If you're really bullish on Bitcoin, then your reserve price to sell to an HPC is going to be a lot higher. And what's funny is that, a lot of the work that we wrote about this summer, at that time, Bitcoin was $50,000, $60,000. The rise in Bitcoin in the last week or so to nearly 90,000 kind of changes the math on whether I want to mine Bitcoin or whether I want to do HPC. So number one, are you a Bitcoin maximalist? If you are, you probably want the volatility and the beta exposure to Bitcoin. If you're not, then you're probably someone that looks at Bitcoin mining in the business of just basically arbitraging power. And so if that's the case, then you can do HPC and earn a nice return, give up some of the upside related to Bitcoin mining, but you have a nice predictable return cash flow that you can lever up to kind of juice your returns on equity. You don't have the high upside of like winning in Bitcoin, but it can give you a nice solid capital return. So it's number one. Are you bullish on Bitcoin or are you kind of indifferent to Bitcoin and are looking at Bitcoin mining as a way to arbitrage power? The other thing I think you'd want to consider is, what's your capital, what's your liquidity? And so if you don't have the money to continue to buy the most modern machines and your machines are becoming increasingly obsolete and you don't have a power cost advantage, it may make sense to either sell your power access, so just literally sell completely, or get into HPC as a way to kind of continue to kind of compete and generate, cash flows. So I didn't answer your question directly. It really depends on, your starting point. Do you have liquidity? Are you bullish on Bitcoin? And so that is that. Now, what I will say is this though, like we've been waiting for, so obviously the Core Scientific CoreWeave deal was announced this summer and they've done several follow-ons. But we've been waiting for like another company to announce another deal with a marquee hyperscaler. And it hasn't happened yet. Applied Digital has a letter of intent out with someone, and the market is just waiting for that deal to kind of come out, see what the terms are, what the returns on capital could be, et cetera, et cetera. But we're kind of in a holding pattern. And what I've been telling clients is that I think the Core Scientific CoreWeave deal is very unique in that CoreWeave agreed to foot the vast majority of the CapEx related to upgrading the facility. Mm-hmm. And so that deal offered Core Scientific insane returns on capital because they didn't have to put up much capital.
Yep.
My thinking is that going forward, future deals with companies not named Core Scientific and CoreWeave will require the Bitcoin mining operator to front the CapEx costs, which, kind of throws off the returns on capital. We had done to give you guys a little framework. We had done some work about a month ago where we looked at, returns on capital for Bitcoin mining versus data centers. And fixing the cost of Bitcoin and the hash rate, we calculated a return on capital for Bitcoin mining in the kind of mid 20% range. For HPC data centers, we found it to be, mid-teens, maybe high teens. And so that's the trade-off we talked about. If you're bullish on Bitcoin versus would be willing to pursue HPC. So again, like if you don't have capital, like you probably want to think about selling to maybe a hyperscaler, depending on your location, or maybe selling out to one of the larger miners if you can't afford to buy new machines. Yeah. And so
go ahead, finish your thought.
I was going to say, and the third piece, which I think will be less likely for the mining space at scale, is literally, selling full-on compute. So the examples that I've talked about is co-location, where you essentially build a data center and then let Microsoft or whoever come in and install their own GPUs, and they'll pay you a monthly rent for that. The third option is like you build the facility and you buy the GPUs. And so one of the companies we cover, Iron, has that strategy. Now they're doing it on a very small scale because it is so capital intensive. But that's the third one. Like I said, I don't think that one happens at scale because it just costs too much to build out. But it offers, potentially higher returns on capital because you're taking on more risk and more capital, startup costs.
One of the things that you point out in that report that I thought was overlooked or can be overlooked is the idea, going back to miners being acquired by a data center company or a hyperscaler or something, is that allows these companies to jump the line for things like power approvals. And I think that that's an overlooked aspect of this. Is it's not just the infrastructure part of things. If the company is capitalized enough, you're talking about some of the most heavily capitalized and institutionally connected companies in the world in the tech space. They can handle all of that, but it might be a pain in the ass for them to wait for 2 years to get a PPA approved and to get all of that, rubber stamped, and because it takes a long time.
Sure.
And anyway, I think that going back to the acquisition route, I think some people, including myself, kind of underestimated the routes in which miners might have an exit within this market. And especially if you point out, it can get really weird really quickly because there's a window of opportunity. And, we are not adding power quickly enough in the US to meet this demand. So there could be a moment where you just have a mad dash for a lot of these assets, and a lot of miners find themselves in a favorable position.
Yeah, you're totally right. And there's an interesting dynamic that I've noticed. So, we've seen CoreWeave do a deal with Core Scientific for immediate power. I've not seen any other big tech company announce a similar deal. What we have seen is that these bigger tech companies have announced, large long range deals that provide power in 2030 or 2028 in different markets. And so it's funny, everybody talked about the power shortage, but it seems like, and the analogy I used is that it's almost like the big tech companies are all on the same plane, and the plane is delayed. And so long as nobody gets off the plane and tries to take a private jet to the location, we're all delayed. So there's no rush. If we're all late, then we're all on time. You know what I mean?
Right.
And so I think if you see one of these tech companies jump out and do a deal that accelerates their path to power, it could light a fire under the other ones. But right now they're all kind of looking around like, all right, you're waiting. All right, we're stuck here on the runway. So you haven't seen like that urgency. And so going back to the point I made earlier, I think, we're all waiting for somebody to announce a deal with a hyperscaler to kind of validate this idea of kind of jumping the line. One other thing that's, I think, worth pointing out, we've done some work and we found that, there's roughly, I think, 20 to 25 gigawatts of data center capacity in the US today. It's, active and running. And the FERC estimates that I think 15% of that is being used for AI. 10 to 15% is being used for AI compute today. And so what I think is happening, or could possibly be happening, is that there may be a reallocation of the existing infrastructure that's cloud data centers, and they're being repurposed for AI in the near term. And so, like, if there's 2 gigawatts of AI capacity, running today in the United States, a small shift of 1 gigawatt could be a 50% increase in capacity. And so I think what's probably happened is that these larger tech companies are probably reallocating some of their existing infrastructure to AI in the near term, to kind of support that. And so they haven't felt the need to necessarily go out and do a deal with the miner just yet. But again, like, we're kind of waiting for that. I think if a deal gets done, it will certainly be a nice catalyst for the space, and it validates this thesis that, like, there's a power shortage, and tech companies are keen to jump the line. Last thing, I think if some killer AI app is developed in the next 6 months that has like real monetization behind it, like, that could change things too. And so, like, right now we've got the large language models, and there's a lot of like expense reduction type of use cases. But if there's a new killer application for AI that everybody has to jump on, in the near term, I think that could change and accelerate increased demand for like more immediate power. But we're kind of waiting for that to happen.
Okay, Colin, I think you had one other one that I really liked, which was the TeraWulf one. It's the 5th largest pubco by market cap. Any thoughts on them? They jumped in October, and you guys covered that in your October report. And then the flip side was Bitfarms was the lowest gainer that month. I think it went down 9%, and TeraWulf went up 39% that month. It was a little over 30%. How do you kind of see those things? Just when you cover these things month over month, and you give these out to your institutional buyers of reports, how do you guys sort of give them this information and allow them to make purchase decisions? Because everything changes so much month over month. I mean, by the time this podcast goes out, the market will be very, very different. And 48 hours leading up to the show, like, Bitcoin pumped almost 10K. So I'm curious about that.
Yeah, no, it's so, in the case of like Bitfarms and TeraWulf and all the companies that we kind of look at, like, we kind of report on them on a look back basis. And so we can tell you that this stock was the best performer last month. Sometimes we're able to attribute that to something. Oftentimes there's no rhyme or reason for why these stocks outperform or underperform or things like that. What has been interesting, I think, since the election, and things may change by the time this airs, but the names that had the largest HODL balances, coincidentally, tend to not be very HBC exposed. Those stocks have actually outperformed some of the more HBC centric thematic names. And so that's something that, we're kind of watching. But yeah, like, it's very hard to explain the movement in the stocks. One of the things that we do publish, and it doesn't give you an exact, buy or sell signal, but we look at valuation. And so we'll look at valuation in terms of, enterprise value versus a company's, existing exahash, their target exahash, their megawatt capacity, the target megawatt capacity. And you can look at all of these things and you can draw conclusions about, some companies are trading rich relative to others, and some companies make, appear to be really good values for investing. And so we kind of point investors to that as well. And so, I can't say that, the stock is going to rally next month, but I can tell you that this stock looks cheap relative to this stock based on, kind of all of these metrics. And you can do with that what you want.
Okay, my follow-up question, and it'll be my last question before I hand to Colin for any final thoughts. When you're looking at the general mining market, do you feel it's overvalued or undervalued as just like a aggregate market cap basis? Like, because you guys always give like these weights things and say, we'd want to purchase it or not purchase it, basically is what it boils down to. But when you're looking at the general market, do Do you feel like it's too big right now, or is it too small? I forget what the aggregate is. You put it in your report last month.
The market is certainly running a little hot of recent historic norms, so it looks a little rich in that regard. Yes, I'd say it looks a little rich on those terms. It's funny. We didn't talk about it today, but the way I think about it, so how I interpret that is that the market is assuming a higher Bitcoin price than is currently the case. And so like you could do the math and say, all right, these stocks are trading at 30 times or 30% of the reserve ratio, the proved reserve, which is 2x its normal amount. Like you can do the math and figure out like what's implied for Bitcoin prices to justify that. And so if that's the case, it's almost like, all right, the Bitcoin mining market is saying that Bitcoin is at $150,000 where it's really at $90,000. And so like maybe I'll buy Bitcoin and short the Bitcoin miners. Like you should see those things converge over time. Something else to think about, we didn't get into it, but it's a concept that we've started talking to, is you can look at the market cap of the companies, and you can look at their hash rate, and you can figure out like how long it will take them to mine the Bitcoin that would support that market cap. And when we did this analysis back in October, some of the results for some of the companies were startling. At that time, we looked at Marathon, and the stock was trading at like 40 years of production. On the contrary, we had other companies that were 4 or 5 years. So to give you some perspective. And so, one of the other ways you can look at it is, all right, how long will it take you to mine, at the current price, current hash rate, et cetera? Like how much time would it take you to mine enough Bitcoin to justify the price of the value of the company, which is another, I think, interesting way of looking at things. Because you got two options: you can buy Bitcoin outright, or you can buy machines. And so there's that play. And so all of these things should drive prices towards some equilibrium. But it hasn't yet, or consistently, and they kind of valuations bounce around a bit.
I mean, that was one image that I found was really interesting in your last report in October. It was just looking at all the miners for that month, the gain or loss that month, percentage terms, and then Bitcoin. And the only thing that beat it was TeraWolf. Now, like the next month, of course, it's different. So who's to say what? And miners have certainly been a fantastic buy for the most part, 2024. We had like that 6-month period, like March through like September, where it's pretty awful. But if you hodled your mining stocks, Colin, any thoughts before we wrap up?
Kind of a harebrained question, because there's the obvious answer to this one, which is margins will be improved. But how does the current price action really affect these markets, and also how investors are approaching them? And maybe a better question to ask with that is, how does it affect the M&A landscape? Because I think a lot of people were expecting, with hash price so low, that maybe throughout the rest of the year and into 2025, you would see some opportunities for some well-capitalized miners to gobble up the weaker operators in the space. Do you see that changing with this? Do you see it staying the same? Or is it just kind of like the cop-out answer, it depends?
Nah, so I think so. The stocks trade on sentiment, right? And so it's Bitcoin's rallied. The stocks have rallied much more than Bitcoin has. Does it change M&A? I don't know that it does, right? So if the reason that M&A is occurring is because smaller operators don't have the capital to buy new machines and compete, even with the rise in Bitcoin, the hash price is still down significantly from the halving. And so I don't know that the recent move gives the smaller guys much of a case for a higher price. If it stays here or if it continues to climb, maybe, right? Now, that said, I think there's been a big gap between what the smaller guys want and what the bigger guys have been willing to pay. And so that's kind of hindered M&A activity over the last 6 months as well. And that was exacerbated by the interest in this theme around HPC. And so this idea that, it's given smaller operators, almost like a new lease on life or some negotiating leverage that, hey, I'm not going to sell for cheap because this power could be used for HPC. And we think it's worth this. The big publicly traded guys have been reluctant to buy things for more than $500,000 or $600,000 per megawatt. And so you've got the little guys want more. The big guys are kind of holding the line on price. And it's really a game of chicken to see who wants to, who's gonna move first. And so to answer your question, I don't think that the recent move up necessarily changes that environment. I think the little guys are still kind of holding out for a higher price. The big guys are still disciplined. But, in the grand scheme, even with the rally, we're still well below where we were pre-halving from an economic perspective. And that was really the true catalyst for why companies were going to sell. They just couldn't compete in a lower hash price environment.
I mean, at the end of the day, hash price is still like $51, $52 per petahash. So it's still abysmal. Yeah.
Way to leave us on a bearish note there, Colin.
Let me ask you guys: do you have a view on? I would ask you end of 24, but we're almost here. Like, what's your Bitcoin price projection for 26 and network hash rate? In 26.
I mean, it was all about Trump getting elected versus Kamala. I think that either way, the market wanted some certainty. And so that was just going to be like a little chaotic beforehand. I think even if Kamala won, there would be a good chance. I think it's unclear how high it would have gone, but like interest rates coming down, certainty in terms of like what the regime is going to look like.
There were already plenty of tailwinds.
Yeah. And like the Biden administration, as much as Operation Choke Point 2.0, and it's been bad for a lot of tokens, like it necessarily wasn't that bad for Bitcoin because we got the ETFs through. And that seems to be where all the buy pressure is. So I think it would have been okay. But, if we do get these reserve conversations going and maybe more international countries getting involved with mining. There's a headline today about Bhutan has 1 billion in reserve now, and they've been actively mining with like bit deers there. That's all good stuff. So price target, we never do this on the show. We do we do a hash rate target. So I think like 1.5 zettahash is definitely on the table for end of next year. Like
really?
Doubling. Yeah.
And it's funny. We had done a study where we looked at like what would the network look like if you replace the entire network with the current most recent, the most efficient machines, and the number we had come to was something over 1,000 exahash, something similar to what you said. But it would be very expensive to do so. And so, do you think that increase is driven by people just buying new machines and replacing the existing? Because you can look at the power draw for the network. I feel like we're probably capping out on the power draw, and that further increases will come from efficiency rather than people building more Bitcoin mining facilities at scale.
I think a decent amount of it definitely comes from those next generation machines being plugged in and replacing older generation. I would say I think that in the context of the US, a cap on hash rate makes more sense to me over the next few years. I think there are a lot of jurisdictions though that have plenty of power that are going to be tapped over this current halving cycle, where you could actually see legitimately more expansion. The ones that come to mind are like places like Paraguay and the global South. Ethiopia is one that is currently being tapped pretty heavily. It's not that much. It's maybe like 3% of the hash rate on the network currently. But you also have considerations in other jurisdictions like in the Middle East and Russia and stuff like that. So I think that a Zeta hash by the end of next year is actually pretty conservative. I think that we get to that pretty easily. But
yeah.
That's
I think the densive compute, we did show with Asher Ganut of Hut 8 a few weeks ago, talking about their new unit they designed with Bitmain, and just the density of that compute they're bringing into their HPC is nuts. It's honestly crazy. It's like 3x. And so I think we're going to have a lot of these S19s and S19 XPs that are still on the shelves getting shipped to Ethiopia, getting shipped to other places where it's super cheap. We're not going to see that hash rate really come offline. And then we're going to see these new units start hitting the shelves, these S21 plus models. So.
Also, the biggest dark horse here, dare I say, because there is activity going on in this country still, but if the CCP reverses its mining ban in China, we're off to the races. I'm not saying it's going to happen.
Conspiracy corner, Colin.
I know, putting on my tinfoil hat. But I mean, at the end of the day, the Chinese are building coal, nuclear, and solar at a rate that just outpaces any Western country. They're going to want to monetize it. Obviously, AI and HPC will be a factor here. But I don't think it's crazy to think that maybe there could be some mining that resurges in that country. I could be totally wrong. Some people who are actually boots on the ground there would probably tell me that's ridiculous. But we've heard rumblings of miners expanding in certain provinces over there for the first time in a while. So who knows?
Awesome. Well, I think we'll close out there. Reggie, thank you for taking us around the block for the last 70 minutes here. Appreciate your time as always. And best of luck with further coverage going into the winter.
Cool. Good to see you guys. Let's stay in touch.
Yeah. Thanks, Reggie.